Hello, everyone. I'm Hannah Shea, a World Law Group's Manager for Communications and Network Development. Thank you for joining us today for M&A Trends in 2023 with Marsh. This is a meeting hosted by our International Corporate Transactions Group. You have been muted upon arrival, and we ask that you remain so throughout for the courtesy of our speakers today. Your video may be off, which is also okay. There will be time for Q&A at the end, since we have such a large group. I ask that you please use the chat feature for the question, so you can just drop your question either directly to our moderator Andrew or just or to me in the chat feature that you see down at the bottom of your screen. The recording will be available on our website within a week of this event, so that you may share it with any colleagues or clients that you wish to share that with. And with that, I am going to go ahead and hand it over to Andrew Ng, who is one of the co-chairs for the Corporate Transactions Group. Andrew?
Thanks, Hannah. Hello and good evening, afternoon, or morning, wherever you may be. My name is Andrew Ang, and thank you for taking the time to join us at this World Law Group International Corporate Transactions Practice Group meeting. Today, we have the pleasure and the privilege of having the team from Marsh to share with us what they have been seeing, what they are seeing, and what they think we will be seeing in terms of M&A trends in the different regions as we begin this new year. As I believe we have quite a bit to cover, I will first do a very quick introduction of our panel of speakers. First, the rose among the thorns, we have Eileen Chow. Eileen leads the Private Equity and Mergers and Acquisitions Services and Transaction Risk Services of Asia in Singapore. And any M&A lawyer worth their salt in Singapore knows this. Eileen is the one who pioneered the development and growth of WNI insurance in ASEAN and has been doing so since 2007. Next, in no order of merit, we have Leo Flindell. Leo co-leads Marsh's UK transactional risk practice, a team comprising of 30 M&A professionals drawn from corporate law, tax law, restructuring, and insurance backgrounds. Since joining Marsh in 2012, Leo has advised on over 750 transactions with enterprise values ranging from 5 million to in excess of 18 billion. We also have Chris McDermott. Chris has been instrumental in the development and enhancement of the WNI insurance market in the Pacific, where he has executed some of the most complex insurance programs for M&A transactions. Chris also used to practice law in the United States. Then we have Craig Wonker. Craig is a managing director and the COO of Marsh's North America transactional risk practice. Craig has 20 years of experience in the transactional risk insurance sector, both as an underwriter and broker, and has been instrumental in the development and widespread adoption of these products in North America. Like Chris, Craig also used to practice law in the United States. Last but not least, last because I hesitate to pronounce your last name, so I won't, please forgive me, we have Alexander Q. Alex leads Marsh's Private Equity Mergers and Acquisitions practice for continental Europe. He has spent the past 15 plus years in the transactional risk insurance industry, which has seen tremendous growth in the past 2 decades, starting in the Nordics and thereafter across Europe. Okay, let us get on with what the audience are really here for. I would like to start today's discussion with the world's largest economy. And so my first questions are to you, Craig.
Sure.
Is the US entering into a recession, or can the US avoid it altogether? What would that mean for M&A activities in 2023 and even beyond?
Sure. Yeah. No. Thanks for the question. I mean, look, the hope is that we avoid a recession and have that soft landing that everyone is speaking about. And yesterday, the Fed raised interest rates a further 25 basis points, which was received pretty well by the market. That was what was anticipated. Throughout 2022, the Fed has been raising rates at a pretty dramatic rate to get inflation under control, and it's now finally trending, in the right direction. Meaning it's coming down, but it's still far away from the Fed's 2% target interest rate. So I think Commissioner Powell had indicated that they're going to continue to be hawkish, but I do think that the rate at which they'll be raising rates is going to moderate. Now, so from a financing perspective, interest rates are still high. So borrowing costs are still going to be very, very high for buyers. And that's even if banks are willing to lend. And so you're going to see, a lot of private lending facilities develop in 2023. So, for M&A, I think what this means is that we are going to continue to be in a slightly depressed M&A environment in the first quarter and possibly into the second quarter. And then I think the hope from everyone I've been speaking with is that you're going to have a decent rebound in the second half of 2022. Hopefully by then, inflation will be well under control. Hopefully the Fed will have stopped raising interest rates. I don't know that they'll come down, but at least the increase will have ceased. And then hopefully by that point in time, the disconnect that currently exists between buyers and sellers with regard to valuation of properties will have reached an equilibrium, because that's a big problem right now. Buyers, companies that used to trade at 15 times EBITDA now are trading at 10. And if you're a seller, you don't want to sell into that environment. Buyer can only pay X. And so it's going to take some time for buyers and sellers to reach a common ground on valuations. But the cynical side of me says that they'll probably reach it sooner rather than later, because people, in order to make money, need to transact. So they're going to figure out a way to transact.
All right. Thanks, Craig. Thanks so much for that. Perhaps next we move across the Atlantic into the United Kingdom. Leo, the UK equities have been more resilient than many other equity regions. In fact, it is about the only one to end 2022 in the green, I believe. This is despite the effects of Brexit and a period of chaos caused no less by you guys having a total of 3 prime ministers in a year. Are we going to expect the same resilience to impact the UK M&A market in 2023? Or is the outlook going to be gloomy like your weather?
I think it was 3 prime ministers in significantly less than a year. It's been a bit of a roller coaster year. And some of the dynamics we're seeing play out in the UK are very similar to the ones that Craig talked about in the US. But then we have some dynamics that are very individual to our region as well. From an economic perspective, we are seeing the impact of those big global macro events in the same way that a lot of the other participants will talk about: inflation, interest rates, supply chain issues, Russia, Ukraine, everything that every participant on this webinar will be very familiar with. So we have those same macro headwinds and tailwinds that are seen in lots of other regions. Specifically in the UK, we had this period last year where we saw some really significant political uncertainty. And as we know, the markets don't like uncertainty. And we really saw that play out in how the financial markets, the banks, the investment community reacted to that. It was very much a risk-off environment. So that created a really interesting environment. And we definitely saw the impact of that flow through to M&A volumes, particularly as we went into the second half of Q3 and going into Q4. I think particularly around that political piece, we've gone through that piece. We're in a period now of, I'm not going to say quite we've returned to normality, but we do have more stability from a political perspective. At least for the next 18 to 24 months until we move towards the next general election in the UK. And I think the impact of that has been felt. It's been priced into markets. So specifically from a UK political perspective, I see upside from here. We've gone through the difficult piece. It's been priced into the markets. It's now about building confidence with the global communities, and that will take that into a less of a risk on environment. You touched on Brexit. Brexit now, we are now, I think, 3 years into leaving the EU. And that clearly has had an impact, and some industries are impacted more than others. But I think in the most part, we've gone through that impact, and that's now reflected in the market and M&A volumes. And when you look at European M&A last year, the UK remains the largest jurisdiction in terms of target companies, and representing a really significant proportion of European M&A. So, you know, from an investment perspective and from an M&A perspective, that's been priced in. It's understood by the principles to a transaction, and they're reflecting that in how they proceed with their transactions. You know, and just to touch on your comment on the public markets, you know, the UK is it's one of the biggest tech hubs in the world. But our financial markets are less exposed to some of the more speculative tech public businesses as well. So the big sell-off we saw in, you know, what was often referred to as spec tech. Whilst that was seen here, it wasn't seen in quite the same way as it was seen in other regions as well. So it's been a very interesting 12 months. I think as we look forward to 2023, I kind of feel like a lot of those issues have been factored into how people view the UK economy and how we interact with the broader global economy. So I see more upside from where we are than I see downside. However, we're living in a very volatile environment. You often hear that phrase permacrisis being discussed. And with so many different macro events moving at a very fast pace, much like every other region in the world, you know, that outlook can change very quickly, both for the positive and negative, depending on what's happening in the wider world. And I think my final comment would be very volatile world, lots of different drivers of risk within transactions in the UK environment. So we're certainly seeing our clients, both buyers and sellers, really focusing on understanding those risk issues and how they impact the performance of a business, and looking at ways to de-risk either their operational exposures or de-risk a transaction when they're active in M&A.
Thanks, Leo. I'm going to stay with you for a little while longer, because I understand you also cover Middle East and Africa. So for those regions, particularly in light of the sanctions against Russia, you know, resulting in oil demand growth, what's your take for the region?
Yeah, and I'd really split up the Middle East and Africa for the purposes of that question. We are absolutely seeing the impact of Russia and Ukraine on the energy sector driving activity. We've seen significant increases in any subsector that's relating to energy, that relates to energy. So big increase in traditional oil and gas transactions, given the obvious demand and supply dynamic that the Russia-Ukraine situation created. And naturally, part as a result of that, but also as part of the transition to net zero initiatives we're seeing across the world, lots of activity in renewables and sectors focused on creating a carbon neutral energy infrastructure. We're also seeing lots of activity in terms of securing the full energy supply chain from source to customer, you know, particularly given some of that disruption, again, that's been very well reported as a result of Russia and Ukraine. We're seeing both investors and strategics looking to really shore up their access to energy. Africa for us is one of our fastest growing regions. We are seeing a really significant increase in inbound investment. That's primarily coming from either the UK and the US, or it's coming from the Middle East. And this is a real mix of private capital investments, so investments. And strategics looking to begin trading within the region, particularly around energy infrastructure, particularly around financial services and payment processing, and telecoms are the three sectors where we've seen the most activity in the African continent. And I think in terms of both the Middle East and Africa, we expect those trends to grow and to see a continued momentum in terms of investment into the regions in the short to mid-term.
Thanks, Leo. Now we turn to the rest of Europe. Suffice to say, Europe was most rocked in 2022 by the Russian invasion of Ukraine and the energy crisis and supply chain disruptions that followed. However, I read in a recent Reuters article that investors are beginning to flock back to Europe. So, Alex, will M&A activities in Europe bounce back in a big way as supply chain conditions improve? Or will further tit-for-tat sanctions between Russia and the EU continue to dampen M&A activities?
Well, yeah, my guess is as good as anyone, I guess, looking into the crystal ball. But I guess we were a bit surprised in 2022. Activity actually kept its pace far into 2022. It's only in sort of Q4 where we saw a slowdown. So I believe we're some sort of 6 to 9 months lagging the US. So I'm giving Craig a call every 2 weeks here to make sure what's happening in the US, and then hoping that they'll pick up. So we'll pick up in short order. But then taking a further step back is to say whatever happened following the first pandemic freeze wasn't necessarily the normal state of business where we had 6-7 quarters of record volumes. So it's really hard to see what is the new normal, because we had steady growth, and then it was all down, and then it was crazy, and now it's slowing back down. So what we do obviously is to look at the pipeline to see how much business do we have on the go. It's a bit treacherous, I would say, currently, because typically you look at the sort of number of cases you're working on across Europe, but given that the drop hasn't been as dramatic as one would believe. However, the lead times have increased. So that's why I say, the number of transactions might be close to the same, but instead of closing a deal in 3 to 4 weeks time or 5 weeks time, it might take 3 or 4 or 5 months time. And we see a lot of deals not actually being signed and closed, which obviously for all of us is detrimental for business. So it's a different landscape, but I would want to look at it from sort of a 5-year perspective, and to say it hasn't been as dramatic as one would think. Only 3 or 4 years ago. All right. Only 3 or 4 years ago, when you looked into January, it was typically very slow, which it is now. So what's going to happen in 6 to 9 months? Let's see. But it's clearly slower. And I think, Craig's point is super important to make. There is a discrepancy between buyers and sellers' expectations. We're shifting from a strictly seller market into a more balanced or even a buyer's market. And that takes a bit of time. Adding inflation and interest rates and I would say the lack of financing, in particular for the mega deals, will have an impact on total volume. So yeah, a lot of macro issues. Outlook is hard to predict. Leo touched upon a few of the things which drives at least our business. Energy transition being super important. So we see a growth in business in sort of southern parts of Europe. Whereas we see less tech and mega deals in northern part of Europe. So it's a mixed bag, but it's obviously a very diversified region with different industries, players, and etc. But I think in the next 3 months we'll know how 23 will end, and 24 is going to be a good year, I believe.
Thank you for your optimism, Alex. Now we come to Asia. I know for a fact that in Singapore, at least, we were so busy with M&A over the last 2 years that some of my clients were told to take a number if they wanted WNR insurance. Now, if US and Europe continue to face challenges in 2023, we would probably expect to see the weakness spill over into Asia. But with the reopening of China, do you see Asia leading the way in global recovery? Or will we continue to see record M&A activities? And if so, in what sectors?
Well, China opening is definitely optimistic for us. So I'm cautiously optimistic that we are going to do better with more deals this year as compared to last year. For the fact that with China opening, certain industries will boom, manufacturing, supply chain, these deals that were actually not doable last year, they are coming back into the market. But what we can see is that real estate is not going to come back so soon because China real estate has not recovered. Interest rates has caused real estate to be not doable, especially for the core funds. Yield is actually lower than the interest rate. So it's actually no point doing such deals. So one sector is actually down. Other sectors that I think will boom will be India in terms of renewables, Southeast Asia renewables. China is actually I would say for infrastructure, it's very much a government sector, so we don't see so much in terms of infrastructure. But definitely we do see a lot more infrastructure these days as compared to the past, because that seems to be the only asset class that is still holding up in Asia. For mainstream private equity, I think it really depends on the industry. Healthcare seems to be the one that is raising the flag right now. We do have quite a fair bit of healthcare deals that's coming into the pipeline, and that cuts across Southeast Asia as well, mainly. Japan domestic continues to be strong. In fact, I think if I look across Asia with China opening up, I think the only country that I think will have a low pipeline is actually Korea. And that's because leverage is very difficult. Right now, interest rates are going at 10%. That is actually very, very high. And also a lot of Korea deals are actually mega size deals. And like what my colleagues has actually said, for very large deals, leverage is actually very difficult right now, coupled with such high interest rates. So I think Korea is the only place where we think that pipeline could be a little bit patchy. But for China, we have seen it bloom since after October big government meeting. India has never been impacted by Ukraine war, inflation, or interest rate continue to go strong. Southeast Asia, I would say, because it's a mixed bag of countries, so each country has its own attraction, continues to be buoyant, although I would say the way that deals are being done are slower, like what Alex said, is no longer as fast. Japan domestic continues, and Japan outbound has actually come back. So that's actually another green shoot for us. So overall, I think Asia shouldn't look too gloomy. I'm cautiously optimistic.
Thanks, Eileen. Okay, so finally, the Pacific. Chris, if I'm not mistaken, well, the Australian economy has been resilient. There are growing concerns over increased prices and interest rates, and perhaps even unemployment. What is your forecast for the Pacific in 2023?
Well, yeah, like you mentioned, Andrew, the economy here was pretty resilient last year. Demand for resources was strong, which drove some of that. Employment remained strong. Interest rates and the rises did present some challenges. And certainly we saw some of the valuation gap issues that Craig alluded to earlier here, where sellers were holding out for larger sale prices and buyers were balking at some of those. Where does that leave us now? So we had a pretty good year in the end last year, despite some of the gloom and doom. Looking forward, I think despite the challenges, I'm pretty optimistic about 2023. Most of the experts are saying that interest rate rises will continue here for a couple more months, but there's an expectation that the rises will cease perhaps as early as March. And if that happens, the conventional wisdom, I suppose, is that deal activity should pick up back a pace around June or July. So I suppose what I'd say is that we're expecting a more measured and not totally quiet, but less frenetic H1. And then the second half of the year, deal activity to be kind of back where we started, the last couple of years. Although hopefully not quite as busy as 2021, when all of us were on our knees as a result of long hours, late nights, sleepless nights, etc.
Thanks, Chris. Okay, my next few questions relate to trends. Now, in an uncertain economic environment, although I've heard a lot about there being cautious optimism, I believe our audience would be keen to know what trends or wants that you may be seeing from your clients, besides what is covered by traditional WNI insurance. Are your clients looking for insurance solutions to cover deal matters which traditional WNI insurance does not cover? Are we going to see an increased demand of different types of transaction risk products to deal with different situations? For example, distress M&A. As I'm told that a lot of this new stuff are first seen out of the UK, I will start with you, Leo.
I think absolutely. I think I touched on the fact that in this sort of environment with this level of volatility, investors and buyers and sellers of businesses are much more focused on risk. So, in terms of what we do within this market, historically, we've been very focused on W9 insurance, which is a tool to mitigate unknown issues. It's arbitraging the position a seller wants to achieve a clean exit from a transaction, but giving the buyer the benefit of a fulsome set of warranties with a robust balance sheet sitting behind them. There are a couple of kind of ways we've seen that market evolve, and one of the key areas of evolution we've seen in the last couple of years, both in terms of how insurers have come to the market and tried to innovate, and in terms of the demand we're seeing from our client base, is how we insure known issues. So what are the key deal issues that typically are picked up in the buyer's diligence or perhaps through the seller's disclosure, where we have a critical issue that relates to some form of contingent risk issue? It's not guaranteed to crystallize, but if it does, it goes straight to the heart of value. Historically, there were only two mechanisms available to a buyer to solve for that. It was an indemnity from the seller, very disliked, and that seller had to be there in the future to pay that claim. Particularly when it's a financial sponsor exiting, you may have less confidence about whether that vehicle is still there. Or for a price adjustment, which in a competitive environment, that can make your bid less attractive and may prejudice your ability to acquire an asset. So we've really seen insurers start to look at these risks on their merits and say, how can we wrap an insurance solution that effectively removes that issue from the negotiating table, and we transfer that into the insurance market. So we started to see this with tax. Tax is often a key financial aspect of evaluation of any business, because pretty much every business has tax as a key cost item. And also tax can be subjective, and you typically have a tax authority in a jurisdiction who will be looking to make sure you are following the rules appropriately. So where you have a view that your tax structure in a particular investee business is probably okay, but there is a risk, and the advice you're receiving from your tax advisor is, we think this is correct, but there's a risk the tax authority might interpret the relevant legislation in a different way, and if they did, a tax liability would arise. Insurers are now really actively starting to underwrite those types of placements. So, for example, in Europe last year, we saw $1.6 billion of insurance limit placed solely around tax insurance issues as kind of a key enabler for a transaction. We're seeing most of that activity in tax, but that same concept applies equally to any form of contingent risk. So when I look at some of the risks that our team has insured over the last couple of years, it might be the outcome of litigation, for example, particularly around planning permits for renewable construction projects. It might be contractual disputes. It might be title issues, so ownership of the asset. And particularly in the environment we're seeing now, where M&A volumes are slightly depressed, that means there's less demand for the traditional W9 insurance products, because the demand for those products is directly correlated with deal volumes. So we're looking at insurers really looking at ways they can expand their portfolio, and how they insure some of those known issues is a key way that they're doing that. And I think when we, and I suspect most of my colleagues will agree with this statement, but when we look at our businesses over the next 2, 3, 4, 5 years, we're expecting the use of those products and the demand of those products to grow exponentially as a key tool to enable a transaction to go ahead.
Thanks. What about you, Alex? Is continental Europe experiencing the same trends, or are you seeing something else?
I think just adding to what Leo said, I think it makes perfect sense. I think tax and contingent risk insurance is where W9 was 15 years ago. So it's a whole new area of insurance, which could be used both in transactions but also for going concerns. So that any entity making tax structuring can look into tax insurance as a proof and risk transfer element for making sure that the structuring holds. So that'll be a super important growth area for the insurance market as a whole. I think every time when we have a bit of a slowdown, and I've seen a couple of these in the past 15 years, people get innovative and creative in terms of solutions. I think it's important to stress what insurance won't be, because it won't be sort of a shortcut for actually doing transactional work. So you have every time it's a bit of slowdown, you have people asking, can we do insurance instead of due diligence? Can we do insurance instead of disclosures? And unlikely, we'll have anyone taking a bet on a black box. So sound deal work is still going to be fundamental for our industry to be able to ensure this, despite insurers having budgets to conclude on a yearly basis. So what we're looking at in terms of trends, I think synthetic will be part of it if you have the right mechanisms, i.e. the warranties are only in the insurance contract, not in the SPA. But again, we need diligence, we need disclosures to make it to work. I think in particular in this environment, stock markets have picked up lately, but if we have another depression on stock prices, we'll see a bit more public to private, and insurance has a role to play in those transactions if the preconditions are right. So we can replicate what we do in private M&A, we can do also on a public to private. So that's something we're seeing. We sent out a flyer the other day and had 5-6 clients coming back to us and saying, okay, we're looking at targets now, and this is something we will want to look into. An interesting thing for me, looking at sort of Europe as a whole, is that a bit of a slowdown in the industry, which has been crazy. Andrew, you said it yourself, take a ticket for being able to get a quote for W&I. That pressure has obviously softened somewhat, which is good for the jurisdictions where W&I hasn't been a tool, or insurers haven't had the opportunity to get comfortable with that particular jurisdiction. So Southern Europe and Middle East, Israel, Northern Africa, whatever it might be, we can get the time of day with insurers, which is good for our clients ultimately. I think we'll see a bit of a drive on distressed assets. We sort of started to think about distressed already when the pandemic hit, but with all the sort of government funding and then whatever you had in different jurisdictions in terms of delayed taxes and everything, and still cheap financing, didn't really push that through. But I guess now with interest rates going through not the roof, but for people who haven't been around for more than 20 years, interest rates are super high. And I guess, a lot of both corporates as well as private equity will find themselves in a difficult position. And that in itself drive transactional work, right? Carve outs or distressed assets and stuff like that, when people need to refinance or strengthen their balance sheet, whatever it might be. And I think insurance has a very sort of important role to play in such situations, because for a distressed asset, you have now no one to back the warranties up. Insurance can provide you with that. In a carve out, the reason you might be carving out is because you want to strengthen the balance sheet, so you want to have the proceeds at closing, and again, insurance can play an important role. So I guess that's sort of what we see in terms of the next few months and maybe trends, but it's a lot about the basics too.
Thanks, Alex. Oh, that's very informative. I would jump to the Pacific. What are you seeing, Chris?
Well, many of the same things that Leo and Alex are, certainly. I'd say that W&I here has been such a ingrained part of deals that we've been sort of seeking out new deal types and new sectors for quite a while. I think looking at this year that take privates, private equity buyouts of public companies, et cetera, are going to be pretty common, and there's a real role to play for public W&I. That is, W&I in place for a public deal. We've done several of those to good effect, and I think those will continue. The other kind of new frontiers, I suppose, are some of the other areas that were touched upon. I mean, certainly distressed deals, W&I is doable. We have insurer support for those. We did quite a few deals in the infrastructure space last year, including a number of development projects, greenfield development projects, renewables projects, et cetera. So really, I mean, the name of the game here is making W&I as useful for the largest variety of clients on the largest variety of deals. And if parties here and across the world, to be honest, are looking at more complex and structured deal types in order to get deals done in a somewhat challenged macro environment, then we think that M&A insurance products like W&I tax, et cetera, have a pretty important role to play.
Thanks, Chris. What about you, Eileen? Because in Asia, I've not seen, the contingent risk insurance and the synthetic that, Leo and Alex talked about. Is Asia going to experience the same at some point?
There are three trends that I want to talk about. First is something like contingent, but like what Leo says, the focus on tax. So we start to see a rise in tax insurance, and in particular, for exits, indirect disposal of Indonesia, indirect disposal of China, and indirect disposal of Vietnam. As you know, for Indonesia, you have to hold back 5% withholding tax when you actually exit offshore. This has been done away because now we have a tax solution for it. So actually that helps a lot of private equity funds when they exit Indonesian deals to upstream their money and increase their IRR. We did the same trick again with PN7 in China. Although it has to be a minority stake deals, majority stake deals, I guess, is quite clear in China what the rules are. But I think for minority stake deals, actually not very clear. So if it's 40% and less, insurer can again ring fence whatever tax that you have to hold back. And again, you can upstream. The latest toy that we have, which I'm actually toying with, is actually Vietnam. So Vietnam, for many, many years, a lot of clients are talking about CGT. They have to hold back when they do indirect tax transfer. I think by this year, we should have a solution for a lot of our clients who are actually exiting Vietnam. So that is actually one bucket where we have helped a lot of clients and is a new trend. Another trend is on transfer pricing, which we actually work with your firm, Andrew, on one of the deals where we had W&I insurance and we had transfer pricing, which is actually the first transfer pricing policy done in Singapore, in Asia. Which historically, these insurers in London, they are not very keen on, but I think we have actually convinced them. And again, with tax, we managed to do a couple of restructuring deals. So got nothing to do with W&I insurance. It's just purely corporates are restructuring themselves, and therefore there's a tax liability. We have done it in Japan. We have done it in Singapore. So tax policy is not just for indirect disposals or transfer pricing. It also includes restructuring. So I think this whole bucket is one trend that we actually saw in the recent 2 years. And I think it will continue to grow because this is very real. It's talking about known issues. It increases your IRR. It unlocks cash. It's not talking about W&I where it's covering the unknown. So clients get very, very excited over such solutions. The second trend that I want to talk about is fundamental top-up. So yes, it's been around. We have seen that in London. But only in recent times, I think clients got a bit smarter in using insurance. So now on one deal, you can have 3 types of policy: fundamental top-ups, normal W&I insurance, and tax. Certain PE clients where they are actually selling listed company shares, where they only give like 5 lines of fundamental insurance, fundamental warranties, they will get a fundamental top-up policy just to have a clean exit. That's actually quite new. And we have done one listed company in Indonesia for a minority sale exit, where the client actually got a fundamental top-up for 100% of the deal value, and actually managed to, again, have a clean exit. To the buyer, it sounds a bit strange. I'm buying a listed share, and then you're giving me 5 lines of warranties and you ask me to get insurance. But for the seller, who is a PE, this is the best solution that they have. And we started to see it on every single deal. We started to see it in India. We started to see it in Japan. We started to see it in Singapore. So people are asking. Of course, some deals people get, they did place the fundamental top-ups. Some deals, they are just queries. Now, the third trend that I want to talk about is local insurers. As we all know, Asia is very diverse. English is not the primary language for every single country in Asia. So we saw the rise of Japanese insurers writing W&I insurance for domestic deals. And that's a big game changer. I would say it took only 3 years for them to dominate and overthrow all international insurers. When Japanese insurers first started doing W&I insurance 3 years ago, only 2 of our deals were actually written by them. And then 2 years ago, it became 50%. Last year, it was 2/3. And they are actually really giving a run for the money for all the international insurers. We are going to do a client event very soon to actually announce who are the top 3 insurers in Asia. And third on the list is Time Machine. Time Machine is actually a Japanese MGA. I know a lot of people on the call will not even have heard of them, but they actually did majority of the Japanese domestic deals. And why is that a very good trend for our clients? Everything is done in Japanese. Underwriting call is less than 30 minutes. Underwriting questions less than 50. They pay claims in 7 months. You don't need to translate any of your reports. So for a Japanese client doing a Japanese deal, and I'm talking not just domestic Japanese, but even private equity funds who are in Japan, international private equity funds who are in Japan, they are also, latching on this new insurers. And the amount of capacity that they have collectively in terms of Japanese insurers, US 100 million. So that means they can do deals up to US 500 million. So it's not small. So that actually gives our international insurers some fear because Japan seems to be out. And I hope that next year, this time round, China will have the same story. From what I predict, the trend will be the China insurers will do the same as what the Japanese insurers did. Everything in Chinese, no need to translate. I don't know if they have underwriting calls or so. It's wait to be seen as we are developing. And maybe 2-3 years down the road, Korea will lead the way. And very soon, North Asia will have their own domestic insurers for their domestic deals.
Thanks, Eileen. I mean, that was a lot to take in, and it was very useful because I might just have got a deal for you after this. But last but not least, I think we are back with the US. Craig, what trends are you seeing in the United States?
Sure. Yeah, look, I mean, like all these other regions, it's an unsteady environment for traditional W&I insurance because of the level of activity is not what it was. That said, the level of activity is exactly like it was in 2018, 2019, 2020 in terms of overall M&A. That's sort of the new normal right now. The problem is for the insurers is that there's a lot more of them than there were 5 or 6 years ago. So what we're seeing on traditional W&I in North America is that prices are coming down, underwriters are becoming more commercial. So as Leo was mentioning, those contingent risks that may be discovered in due diligence on transactions, insurers have a greater appetite to include coverage for those matters within a W&I policy. Obviously for additional premium. So that's something we're certainly seeing underwriting appetite expand this year. Tax insurance, I think, Alex was right describing it as basically where W&I insurance was about a decade ago. It's last year we did almost $2 billion of limits of tax insurance, but that is obviously very small relative to W&I. But I think as more practitioners learn about it, you're going to see that grow. That said, not every transaction has a tax risk. Every transaction has warranties that need to be insured. So the market's always going to be smaller, but there's going to be a lot more room for growth. And in the US, we're also seeing some expansion of insurance underwriting for litigation matters, so like litigation funding and things like that. That's sort of a new frontier for insurers here in the US, and we'll see where that goes because those are, high risk, high reward. So I think that business sounds good until you get hit with a claim, and then we'll see where that goes. But again, I think this is going to be a year where, in the US, W&I is still going to be the bread and butter of the practice area. With levels that we hope to, exceed last year by, 5 to 10%. Tax insurance, we should see some decent growth and a little bit of growth on the litigation front.
Okay, thank you. We are at I think close to a quarter to the hour. I'm gonna open the floor for Q&A. Let's see if we have any questions from the audience. Okay, I think that's, yeah, let me see. Okay, maybe, yeah, I think that's one that's to me, and I'll just throw it open. Again, in an uncertain economic environment, do you guys foresee any increase in not just the number, but also the percentage of claims under a WI insurance policy in the coming year? And if there's going to be an increase in claims, are there any concerns over payouts? Maybe we move from east to west. Chris, starting with you.
I think that, yeah, I mean, I expect there to be a number of claims, an increasing number of claims, not so much because of economic uncertainty, but more because the product has matured and there are more well-developed claims payment mechanisms and more well-informed parties who know how to make proper claims. So I do think more claims will be paid, but not because of the economic volatility.
Right. Eileen, in Asia?
Well, I foresee we will have more claims, but that's because we are doing more deals. Got nothing to do with the economic environment. But we are starting to see that claims is a differentiator in terms of selecting a broker as well as selecting insurers. Based on the experience that we have, I think Marsh can safely tell you which insurer actually have a better claims process versus others who don't even have a proper claims person to actually handle. In fact, we have 2 claims paid last year, which is considered already a milestone, because before last year, we only had 3 claims paid, considering all the hundreds of deals that we have done. And each of the claim was very tiny. They were in total less than 5 million. But last year, we had 2 claims paid. One was actually by the Japanese insurers, and it was paid within 7 months from notification. And it was a big claim. It was $11 million, got to do with some gradient of building a power plant, which led to a breach of regulations and permits warranties. And the claim process was actually very smooth. So this will be a big talking point to clients in terms of selection of insurers. And there was another claim in Korea where the client was unable to substantiate everything, but the insurer actually paid about 50% of the loss based on what they have and promised them that if you actually substantiate, we can talk about 100%. The client, of course, took 50% because that's the easy way out. But it also shows how commercial this particular insurer is as compared to others. So I believe we will have more claims, we have more experience to share in the coming years, and claims will be a big differentiator in the years to come for Asia, which previously has always been only price for selecting of insurers. But going forward, definitely claims experience will be one of the factors to consider.
Thanks, Eileen. Alex, what about in Europe?
I actually believe that the sort of economics will have an impact on the claims activity, just for the simple reason that people have more time and they bought stuff at the 25 times multiple, and now they're looking at the 15 times multiple, which means that, you know, they'll be chasing cash to a larger degree than they've done in the past, where you could have flipped a target from on a sort of a 7 months basis or a 3 year basis or whatever it was, and then that was more important. So in the meantime, before deal activity picks up, I guess we'll see a bit more structured work around actually getting claims paid instead of just letting it go. But it is sort of a low frequency type of business. Not speaking about the US, I think Craig has a different story here to tell, but given the regime under the SBA, it's going to be different in the US than in the rest of the world, large parts of the rest of the world. So I guess we're going to see a bit more claims, and I think Eileen has a perfect point. The industry is still maturing. We get new entrants here and there, so we need to together with our clients to distinguish between the good ones and the bad ones when it comes to claims. Typically, in my experience, we always get there in the end, but the process getting there can be either smooth or disastrous. And then I think that is what clients will be willing to pay for, to get a smooth process. Typically in the claims I work, then, you know, we have a few multi-million euro, dollar or pound claims under our belt here. So we have some experience. It's typically not an issue of if there is a breach or not. You know, that's something which you can distinguish quite quickly, but quantifying the loss is tough. It wouldn't have been different between a seller and a buyer than it is between a buyer and the insurance company. my guess, because it's their money on the table. So it needs to be negotiated and documented and proven and everything. So yeah, the industry is getting better in terms of process. And that is, I think, a main driver for clients to look into.
Okay, I'm going to jump to you, Craig, as Alex mentioned you, and we're going to skip Leo for a bit. So Craig, over to you.
Sure. Yeah. Claims is really going to be a driver of insurer selection going forward. So historically, we've gotten claim notices on about 20% of the policies we've placed in the US. Now, that doesn't mean the claims get paid. Many of them are within the policy excess or policy retention, depending on your parlance. But what we have seen over the last couple of years is a massive increase in the number of policies written. So we have seen a big increase in just the number of raw claims. And in our most recent claims report that we've put out on a global basis, we've helped collect over $500 million of payouts on these policies. And in North America alone last year, I think that figure was almost 200 million. So that's real money. And as Alex said, getting to a point where an insurer pays, that's great. But if the process is bad, that's a bad outcome for the client. And so we've already seen some insurers really distinguish themselves, and others kind of fall on their face. And so, historically, we've probably focused more on the front end execution in terms of selecting an insurer. But now it's also going to be, hey, those guys are good on the front end, but they're not so good on the back end. These guys are a little bit better. So look, I think that's where a broker really adds a lot of value for the client, because we have those qualitative and sort of anecdotal experiences with these folks, in addition to placing more of this insurance than anybody else. So I think we're able to really achieve good claims outcomes for our clients here. And again, I think focusing on claims execution in addition to underwriting execution is a critical piece of insurer selection on all of these types of policies.
All right, thank you. Leo, over to you.
So sometimes the risk at going last means there's nothing left to say, and my colleagues have picked up the key points. So I thought I'd finish with some context instead. I've been part of this world for just over 10 years. And across Europe, in that year, we'd seen roughly 30 claims notifications across our book. Today, that number, and this is just for Europe, that stands at over 350 claims notifications. So that really shows you the growth of claims activity across that book. Now, some of those notifications are simply notifications. We think we have a problem, but we don't know yet. And roughly a third of them will proceed into more of a formal claims process. So when we look at the use of this product going forward and the value it creates for both buyers and sellers, claims performance is the critical differentiator, because there's no point buying insurance if it doesn't pay when it should pay. So claims as a topic for our clients is very much top of the agenda. And I think as we look forward to the next 5 years, claims is going to be the biggest talking point between market practitioners and their clients.
Thank you. We actually have one question from a friend in Vietnam. People said that the private equity has accrued a huge amount of capital ready for M&A. How do you all view this in your respective jurisdictions? I'll start with Eileen.
Yes, private equity has a huge war chest. We know that. A lot of people have raised funds last year and the year before, but haven't really deployed. Will they deploy very quickly this year? I think infrastructure has a higher chance of deploying. Real estate, no, not for core. Maybe for logistics and data centers. For mainstream PE, I think it really depends on the industry. Those focusing on healthcare, yes. Education, I think is muted. But when it comes to consumer, it really depends on the China story. Large populations like China, Indonesia, where middle class is actually important in order to fuel the demand. I think that really depends on how the economy goes. So I would think their dry powder can still last them a few years. It's not going to finish this year. Definitely this year, with all these rising interest rates, macros not so favorable, China just opened up. I don't think they can finish deploying. I think they can still use it for the next 2-3 years.
Okay, thank you. Leo, I wouldn't let you be the last this time. So what's the situation in the UK?
There's definitely a lot of capital out there to be invested. We've seen some mega funds raised, and we've also seen some funds have to work a bit harder to raise those funds. So, as you look forward to the next 1, 2, 3, 4, 5 years, we think that private capital deployment is going to be a big driver of M&A. But that said, it's not going to be invested without care and consideration. So we need to see the market get to a level of certainty where principals are comfortable deploying that capital. The other piece to that, and it's been touched by several of my colleagues on this call today, is we need the financing conditions to be there to backstop some of those transactions. So the capital's there to be spent, but the environment needs to be supportive of it being spent.
Okay. What about you, Chris? What's it like in Australia?
Leo said it so well just now. I was going to send you a message, Leo, to say how well put that was. But yeah, much the same. The war chests are huge. There's a lot of pressure for GPs to deploy that capital, but they also have a responsibility to use the money wisely. So, I think there will be pressure to use it. I think that means different deal types will be entertained. A good hard look at public deals. Real estate seems to be pretty hot here at the moment. Infra certainly was mega hot last year, expects to be again this year. Yeah, pressure to deploy, but they will be careful as usual.
Thank you. Alex, I assume the situation is the same in Europe?
Yeah, similar, I would say. Again, it takes a bit of time before buyers and sellers' expectations are at the same level. And when that happens, we'll have more deal work to do. I think it's interesting to look at a few of the sort of overall trends. If you look at the capital, the dry powder private equity has, it is more and more put into, if you look at the numbers over a 10-year period, into bolt-on acquisitions. So we're going to see more of those, I guess, smaller add-on acquisitions or combining a few targets into a larger one, which is interesting for everyone on this call, I guess. And then I guess another important driver where private equity hasn't been, in the last few years, definitely, but before, 10, 15, 20 years ago, is on the really large transactions where, mid-market funds where sort of the private equity industry started, and you did those maybe $500 million deals, but now we see the multi-billion-dollar deals being done by private equity. So as we see more dry powder in the market, it's not necessarily going to translate into more transactions, but larger ones, and taking a corner in publicly traded companies and stuff like that. So deployed a bit differently than we've seen maybe in the past, say 10-15 years, in the next coming 10-15 years.
Thanks, Alex. Craig, would you like to round this up with your view on the US?
Yeah, no, I mean, look, I agree with all everything that was said here, right? Every year there's just more and more dry powder, and they're going to put it to work. Though that said, right, remember their time horizon, is normally like 3 to 5 years to deploy it. I think everybody, the world got a little bit out of whack where you'd raise a fund and spend it all within 12 to 18 months and go back out to the market. That's over, at least for the short term, right? So because limited partners can't redeploy capital unless they're getting money on exit, and nobody's exiting right now. So the fundraising market's going to slow down a little bit over the short to medium term. But I agree with everything my colleagues have said, is that the money's there to be spent once the market conditions are kind of more favorable for both buyers and sellers.
Thank you. I believe we are just about out of time. This just leaves me with the pleasure of thanking our speakers today, Craig, Leo, Alex, Eileen, and Chris, on behalf of the World Law Group and all our guests who join us here. Thank you so much for spending your precious time with us and sharing your insightful thoughts. It has been a very fruitful hour. And so can everyone please just join me in a round of applause? Thank you, the Marsh team.